The purpose of investing into a fixed income instrument at the end of the day and why people get attracted towards FD as an asset class is primarily due to the security, right?
Post-tax FD returns do not cut inflation, do not beat inflation. And that's where the problem lies.
People today still do not really grasp that just how shares of a company can be traded today in the stock market, bonds can also be traded, right?
So it's just that the concepts of equity markets have really caught up with the individual investors, while the concept of debt markets haven't.
Obviously, if not FD, where do I go, right? I do not have sufficient amount of understanding of other investment options out there. I do not want my capital to be put at risk for, let's say, additional 200, 400 basis points of returns.
SDI overall is securitization of cash flows, which are contractual, periodic, and predictable in nature.
But in all probability, today, we are at the peak of the interest rate cycle. So today, it is the best time to be investing in fixed income because you get to benefit in a couple of manners. Welcome everyone to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I'm the founder and CEO of Daulat Wealth Management. Today, we wanted to do something slightly different. We wanted to talk and discuss about a topic that is very relevant in today's investing environment, and more so in the context of where we are in the interest rate cycle and how our investors and audience today can better position their portfolios to take best advantage of that. And to that extent, we are pleased to be hosting this joint webinar with Grip Invest, which have pioneered fixed income investing for retail investors in India today. Grip is a new age investment platform that offers a portfolio of curated investment opportunities beyond your traditional investment products like stocks, FDs, and gold. Its mission is to provide a suite of products across securitized debt instruments and a portfolio of curated bonds that offers investors an opportunity to earn a periodic, stable, and non-market linked products. And this is something that we are going to touch upon later as to why such a proposition to an investor's portfolio is more so relevant in today's environment. And I'm really pleased to be joined with Vaibhav Ladda, who is joining us from Grip Invest as the Chief Business Officer. Vaibhav is the Chief Business Officer at Grip, and he oversees pretty much everything across the demand side at Grip, including retail investor participation, wealth management platforms, and post-sale support. Prior to joining Grip, Vaibhav worked with a bunch of startups across India and the US before deciding to come back to his hometown and take the plunge with doing something entrepreneurial. He has earned an undergraduate degree from IIT Delhi and an MBA from University of Virginia's Darden School of Business. Vaibhav, it is an absolute pleasure to have you join us today, and I look forward to discussing more about opportunities in fixed income for retail investors today.
Hey, hi Varun. It's a pleasure. Thanks for having me here.
So Vaibhav, before we get started, I think something that we have discussed always is the love that Indians have for this product called fixed deposit FDs, right? No matter what we talk about in terms of the penetration of different asset classes and where everyone needs to be invested, people still have this affinity towards a relatively safer instrument where they know that their principal is protected and no matter what, they'll be able to withdraw their money when they want. So why don't we give some color to our audience today with respect to where exactly Indians are invested today and what really is the size of the mammoth FD market?
Yeah, sure. So there are four broad asset classes that Indians invest in, right? It starts with fixed income, as you said, which is the lion's shares of all Indian savings, investments, etc. Second is equity and equity instruments. Third is real estate, and fourth is gold as an asset class. Let me begin from gold. Gold, primarily for Indians, is an emotional investment rooted in tradition. Real estate, on the other hand, is also an emotional investment, but I would just want to keep real estate and gold outside of the discussion because there are non-money market instruments, they are illiquid, and so on. If we talk about fixed income investments and equity investments, this is how the chart looks like. Okay, overall 30 lakh crore savings for Indian households, and you can see 70% of that is either cash or fixed income investments. Insurance also in India is kind of like a fixed income product. So you can probably say 87% lies in fixed income instruments. If you dig deeper, even within this 70% of fixed income investments, majority is into fixed deposits. And we talk a lot about mutual funds and debt mutual funds, right? But if you take this pie, only 4% of it is invested into debt mutual funds. And this is vastly different from what you would see in developed economies, right? And great, you said Indians like security. Security is great. You're still putting this investments into fixed income investments, but there's just one problem, which is inflation, right? So, and we are in an increasing interest rate environment right now, right? Of late, the FD rates have been quite high. And even in these times, if you see, post-tax FD returns do not cut inflation, do not beat inflation. And that's where the problem lies. So now we are looking at 70% of investments of Indian households, which is not beating inflation, right? And that's essentially the problem with just fixed income, just fixed deposits as a fixed income investment.
Right. So that's a good point, right? I mean, so obviously, intuitively, it makes sense that you need to obviously move into more market-linked products, something that is able to give you a real rate of return, right? Over and above what inflation can give you, right? But when we go out and speak to a lot of the investors, yes, people do realize inflation as a concept, right? But it is just stops at that, right? People will still not take into account because, again, the numbers can look really different depending on how you slice and dice it. People do not really take that into account whether I'm beating inflation. The purpose of investing into a fixed income instrument at the end of the day, and why people get attracted towards FD as an asset class, is primarily due to the security, right? When they are investing into FDs, they're not really looking at returns, so to speak, right? So that is what our experience has been when we go out and speak to a lot of the investors, that yes, they do realize that FDs are not able to match inflation rate. Probably the returns are really, really subpar. But the next question then becomes, obviously, if not FD, where do I go? Right? I do not have sufficient amount of understanding of other investment options out there. I do not want my capital to be put at risk for, let's say, additional 200, 400 basis points of returns. And FDs as a concept has been so ingrained in the Indian culture right from the childhood, when you're seeing your first generation, second generation family members just putting into that, that inadvertently you end up defaulting to it.
Yeah, and that's a good point. See, 5 years ago or maybe 10 years ago, people did not even understand inflation and how it is eroding wealth. I think right now, more and more people, a majority of people understand inflation as a concept. Still, there are lack of alternatives. And before I jump into or seeking alternatives, right? Let's just see how do fixed deposits work? Like what's the journey of fixed deposits and onward use by the financial institutions, right? So if you look at it, we individual depositors like you and I put fixed deposits into a bank, right? If you look at the upper side, that's the fund flow. So we put fixed deposits into these banks. Um, the banks don't keep fixed deposits in their accounts, right? That is used for onward lending to other financial institutions and corporates. And those are done through debt instruments. These debt instruments could be corporate bonds, which are issued to corporates, securitized debt, which we would touch upon today, and also government securities where, banks lend to government. Of course, it's a simplistic chart to make the audience to make it really simple for the audience. And so banks would onward lend to NBFCs. NBFCs would onward lend to corporates. Banks also directly lend to corporates, and this basically is the ecosystem of debt capital markets. And just I'll bring your focus to the interest rates. When we put fixed deposits in banks, we earn an interest rate of 5 to 7%, depending on where we are in the interest rate cycle. When banks lend to NBFCs, banks receive an interest rate of 8 to 12%. And when they onward lend it, they earn an interest rate of 10 to 16%. So as we go down the funnel, the interest rates keeps increasing. So it's funny how the same fixed deposit that we put into banks is circulated onward. And of course, it's a simplistic explanation. But what I'm trying to say is that this is what is called net interest margin, right? And is there a way where individual depositors or retail investors could directly participate into debt capital markets? And that could be an alternative, because as you see, the interest rate keeps going up as we go down the funnel, and that's where the participation in debt capital markets happen.
Right. So I just want to clarify for the audience right now what Vaibhav had just mentioned, that obviously I think banks do a lot of the heavy lifting in terms of, identifying who the borrowers would be, where an individual lender, as an individual depositor, we do not have access to such kind of information, where we have the ability to assess whether a particular borrower is credit worthy or not, right? And that is where the spread over what banks give to us and banks charge the borrowers actually come into the picture, right? From a very simplistic point of view, when banks give out loans, we do not have that capability to assess and underwrite those loans, and that's why we go and give that money to banks, and banks then go and onward lend it. What he's now trying to tell over here is, rather than now giving that money to banks, why don't we devise a method through which we directly lend to those corporates who are borrowing from NBFCs and banks at 10 to 16% at a marginally lower rate of interest, right? Where corporates also are able to directly access us, the retail audience, without going through banks and NBFCs. And that is where instruments like bonds and securitized debt instruments actually come into the picture.
Yeah, and just to add, not to say that retail investors like us would actually go and do the due diligence of the corporates or where the onward lending is happening, right? But can we directly participate into these corporate bonds, which are already undertaken, the due diligence is undertaken by these financial institutions? The answer is probably yes. Yeah, but the participation has been really low in these debt capital markets.
Right. So yeah, moving on, Vaibhav, I think so now we have clearly understood, the size of the FD markets, why that is the case, where people are investing into fixed income and specifically into FDs. And then the question becomes, okay, if not FD, where do I go? I need to have a similar level of security, if not slightly lower, if I want to assume a slightly higher rate of return. But what is the alternative that is available to me that is easily accessible for an individual in India today?
Yeah.
So this is again an interesting point, that and the chart that you have brought up, and this again relates to what we have talked just now. That if you see what the chart over here is showing you is the composition of debt mutual funds and equity mutual funds. And if you see the first pie chart over here, over 60% of the assets in debt oriented schemes, so that could include liquid funds and the entire category of debt mutual funds, are actually dominated by institutions, right? Over 60% of the assets are actually invested by them because they understand that asset class really well, and then they go and participate it. The retail participation, the individual participation is still limited to, I would say, the HNI, UHNI category, and then there is only a sliver of that which actually comes and participates in debt oriented schemes. But if we flip the coin to equity oriented schemes, that is where you see 90% of the assets coming from individuals, because again, equity as an asset class is very, very well understood. People do intuitively understand that they're investing into the stock markets, they're going to participate in the rise of the corporates, and so that is something that they can understand, that is the true source of wealth creation for them over a longer period of time, depending on what their risk appetite is. But that is where a majority of the individual assets actually come into the picture. Debt oriented schemes, liquid and money markets, ETFs, again, whether that's debt ETF or equity ETF, that is a separate point of discussion. But the point that we are trying to make over here is debt as an asset class, debt capital markets specifically, when you're investing into bonds, NCDs, directly or through a mutual fund structure, is continues to be dominated by institutions.
Yeah, and I mean, it's not like 10%, 20% higher, but the difference is incredibly high, right? Like 89% of equity-oriented schemes driving 90%, 89% from individual investors versus 40%. And not just that, even if I talk about overall corporate bond market or debt capital market. So outstanding debt capital market as a percentage of GDP in India is at 15%. And if I just take another example, not even a developed economy, emerging market like South Korea, the same number is at 70%. And that just says, one, the retail participation is low, but also the overall market has so much headroom for growth in as India's debt capital market.
Correct.
Yeah. And there are reasons for it, right? There are reasons why retail participation has been low in these debt markets. And first and foremost, like you said, I think I think the awareness and knowledge levels have just been really high for equity markets for whatever reasons, and that has not translated into debt markets.
Right. So I think what maybe perhaps could be a reason over here is when they're looking at fixed income, they want a product that is really simple. So to the extent that let's say today they go and put in 100 rupees with the bank in the form of an FD, they know for sure that at the end of 12 months or whatever the tenure is, they are going to get that principal back and then some interest, right? So they exactly know they are able to plan out their finances in a manner where they are able to see what the repayment schedule exactly looks like. But when we flip the coin and see and specifically look at more a market linked product like a bond or an NCD, there obviously the concepts tend to be a lot more nuanced, where you need to have an understanding about the yields, about the tradability of the bonds in the secondary markets. And you'd be surprised, people today still do not really grasp that just how shares of a company can be traded today in the stock market, bonds can also be traded, right? So this is something as a concept that is still not penetrated very well with the retail audience. That's that. Then there is the concept around security and how credit ratings actually affect the pricing of the bond, right? So if you're looking at investing, let's say, comparable to, let's say, an HDFC Bank, which is a AAA rated security, that will give you about 7.5, 7.8%. If you're lending to Government of India today, they will give you about 7.1% return on your capital, right? So again, there are multiple buckets where you could go and put in your money, but you need to have a good understanding of what the credit ratings are. And credit rating simply means and is a measure of the credit risk. What they're trying to tell you, if you go and put your money with a certain issuer, right, whether that's a bank, whether that's a corporate, what is the risk that your principal could be at a loss, right? So lower the credit rating, higher is the risk. Simple as that. And then higher is the return that they would be willing to give you. So there are multiple concepts that also people need to be aware of, and this needs to be displayed to them in a very transparent manner. Which again, I've seen that a lot of the broker dealers, so who actually tend to downsell bonds on their book, do not give a complete and an accurate picture of what the risk entailed is when investing in a market link product. And then whenever, let's say, a black swan event happens, like in the case of a default of a DHFL, right? Once investors' capital is at risk, or if that's not protected, I think that then just leads to a very, very negative domino sequence of events, where just because they have had a very bad experience, in all likelihood, they are going to stay away from that asset class. And then there is an entire process of trying to explain to them as to why that was the case.
Yeah, but absolutely. I think these things are nuanced. You know, you have to understand it before you go deep into it. But if you think about it, uh, even in so for you were talking about credit ratings, right? So debt capital markets and the regulators and the agencies have done a reasonable job of objectifying or quantifying the risk, where credit ratings are the spectrum goes from a triple B to A to double A to triple A. And if you think about equity markets, the classifications are small cap, mid cap, large cap, and so on. It's just that the concepts of equity markets have really caught up with the individual investors, while the concept of debt markets haven't.
Right.
Uh, uh, think about it. People are trading, FNO in equity markets. They're doing technical analysis, finding patterns. Those are also not easy concepts. It's just
Right.
that the awareness has been really high, and yeah, and the concepts have caught up. And of course, other reasons of ease of use, etc.
Right. I think so much of it also, honestly, Web of Tech also needs to, um whether you want to give them credit or not, is the gamification of the entire equity markets, right? Where you sort of go and buy a stock and then you have confetti popping around all of your screens, that's happening in India. That's happened, I would say, ever since COVID, where you have seen a lot of the young population suddenly got into the equity markets, primarily because it has become so easy to enter it. And uh, the thrill, I would say, that people get of finding multi-baggers, and then the entire concepts around how to find those things. There's so much literature around equity markets, long story short. And I think that is also a reason why debt to a certain extent tends to be lacking over there.
Yeah. Yeah, and you said about gamification, etc. Right. So the second reason I would say is this, that there are just not enough platforms, enough new age platforms, right, which are retail investor friendly, which are easy to use, which provide transparencies. There's just a general sense of opaqueness when you see, brokers driving the bond markets. And yeah, and again, it's an issue for the retail investors to get in, while if you are large fund managers, large family offices, probably you will get that access from the brokers at a transparent pricing, and you will get those opportunities. But for retail investors, it is still kind of like a black box, and the penetration that has happened in equity markets has not happened.
Absolutely.
Yeah, and I mean, huge respect for Zerodha or a Bro, who have, also fueled this rise of retail investing, made it easy to use, transparent in the equity markets. But that has not just happened in the fixed income space. Yeah. And of course, the third reason for this retail participation, I wouldn't say that it is a systemic reason, because these are cycles. But of course, if you think about the recent times, the Indian equity markets have outpaced all the other markets, be it developed, be it emerging markets, and so on.
Right. I think what we are seeing for audience today, the chart basically displays the performance of the MSCI India index compared to, let's say, its counterpart of the emerging markets, which is displayed in black, and the all country world index and the world index. Right. But what it basically trying to tell you is that ever since COVID, over the last 4 years, our equity markets have gone through the roof. Right. So many of the investors actually entered the market at about then, and barring a few months of blips and volatility that they have seen, they have literally just seen a market which goes up and to the right, right? If we sort of go back 1 year back in time, when we were talking about recession and everything, and there was so much the commentary around gloominess was so hot-handed, you wouldn't have expect that by the end of the year today our nifty would be sitting and giving you returns of 20-25%, and small and mid cap would be giving you about 40-45% returns, right? Once you have those anchoring points in your mind, and once you see an alternative opportunity where you could gain a significantly higher amount of return, anything below that starts to look a bit substandard, right? And that is also, you can see that is being represented in the composition of the equity oriented schemes and debt oriented schemes. That is the reason why retail investor participation is so high in equities, because again, they find that to be the true source of wealth creation. And then the concept around having an asset allocation based uh, uh, investment portfolios, having a balanced portfolios, I think all of those concepts just go and is through the wind, because yeah, those things actually come into the picture when you are seeing a volatile market. But when, again, when you're seeing a market which is unilaterally travels in one direction, people then start to, obviously get greedy, start to drift away from this asset allocation and start to basically pump in money into equities, right? The concept of fixed income, the concept of debt is to provide that cushion to your portfolio, right? And obviously, that is something that needs to be better appreciated by the investors, and that is when I think you will see start shifting some money once some profit booking has been done from equities into debt.
Yeah, and even here I would say, and how asset allocation is so important, right? And even here, and I generally tend to say this, looking at these 2 year, 3 year charts are not the perfect representation of how retail investors are investing or profit booking in a market. Because over a longer period, you might see the returns on the higher side, but equity returns are volatile and they are non-linear. So even during that period, retail investors will enter and exit at multiple times and might actually be caught on the wrong side of frothiness.
Right.
And that's why it's so important to have a fixed income portfolio as well. And if you see some of these reports from platforms like Zerodha or Grow, whether you talk about the growth in demat accounts, whether you talk about growth in SIP accounts, they actually happen towards the later end of the bull cycle, right? And when actually the markets turn bearish, the outflows tend to happen, which is the exact opposite of what a seasoned fund manager would do.
Right.
So even though equity markets look great on the outside, and like of course you need to have an allocation to equity, but the diversification is important.
Right. So we now, wherever we have clearly seen, why today, if investors are investing into fixed income, where are they investing? And today, if they want to look at an alternative, why they have not found an alternative, and what is the reason for that retail participation to be so low? So what do you think is the solution? And specifically with respect to GRIP, what have they done in broadening that access to fixed income products? If you could just touch upon that a bit.
Yeah. So when we started out GRIP, we were asking the same questions. We were focused on a fixed income product creation, and the question that we were asking was twofold. One, could there be a product which could give substantially higher returns for marginally higher risk? The returns needed to be disproportionate to the risk, and only then it would make sense. And the second part was, if we are able to create something like that, how do we offer it for retail investors? Again, same things, easy to use, tech driven, and fully transparent. In one line, this was the problem statement: substantially higher returns for marginally higher risk. And as we move forward in the journey, we created a product which is a securitized debt instrument. We'll call it SDI, which is exactly like a corporate bond, but provides this attractive risk reward returns. If you see on the left side of the chart, and we'll talk about more details on it, but an FD, it gives you around a 6.5% return, and an SDI by GRIP gives 13% return. So the returns are clearly significantly higher, and then we move to what's the risk. An FD is considered to be a AAA. A large bank FD would be considered as AAA at 6.5%, and 13% returns would be commensurate to an A-rated SDI. A-rated SDI is still several notches higher than a BBB rating, which is considered an investment grade rating. And that's where it is marginally higher risk, but significantly higher returns. Again, disclaimer: this is not a pitch to move your entire FD into an SDI. FDs are required for an emergency fund, but then could we allocate a portion of our portfolio into products like SDI, which are fixed income, but also be inflation significantly and also provide an alpha in your fixed income portfolio.
Right. So just to clarify what Weber just mentioned, that obviously from a risk point of view, it is not that you're taking a like for like risk. Obviously, you are taking a marginally higher amount of risk, and that is denoted with the credit rating that is assigned to each of these SDIs which come into the market. And then you can see correspondingly the return, right? So obviously, if you go up the ladder, so AAA being the safest instrument, once you start going, let's say, notches below that, so let's say a double A or a A, once the risk starts to increase, you need to get compensated for assuming that risk, and that is basically reflected in the yield that you are earning from the SDI that you are investing in. So you need to keep those things in mind. It is not a like for like product. It is not an absolute replacement product, as he has just mentioned, but it definitely warrants a certain allocation depending again on your risk appetite. Complete disclaimer on that, depending on what your risk appetite over here is, how well you understand those instruments, only then you need to go and participate in a fixed income product like an SDI. Again, the point that we are trying to make over here is that do not look to generate equity like returns from a fixed income product. This is again a mistake that we see a lot of the investors tend to make, gets magnified during a bull market where you have platforms advertising 16%, 17% risk free returns, right? The moment you see that, you need to know which end you need to run to, right? So obviously always understand the risk that you are assuming by investing in a fixed income product, and if it does not meet your risk appetite, you are completely fine with putting your money with the safest instrument. That's also completely okay.
Yeah, absolutely. So just and before you touched upon regulated products. So before we go into what an SDI is, I would just like to clarify that it is fully regulated by SEBI and RBI as a product. Instead, in fact, we took the framework from SEBI. SEBI designed the framework and we just created the instrument and took it to the market. Second point, since we are already talking about rating, all SDIs, like you said, are rated by rating agencies. So these are not one of those unregulated, unrated products. Okay. So this is, SDI is the broad asset class, but I'll take an example of loan X, which is one of the SDIs that GRIP has created. SDI overall is securitization of cash flows, which are contractual, periodic, and predictable in nature. So let's just look at this example. There is an NBFC. So if you see, there are NBFCs. The business of NBFCs are, as we also saw earlier, is to disburse loans or do onward lending of loans. Let's say an NBFC has disbursed a pool of 100,000 to 200,000 loans. These could be MSME loans, income generating loans, personal loans, and so on, depending on which NBFC are we talking about. What CRIP does is CRIP takes a pool of high quality loans over and above those 100,000 to 200,000 loans. So the 100,000 loans are originated by NBFC. They have a certain quality which is already due diligence by the NBFC. That's their mainstay business. So they are good quality loans. But CRIP cherry picks an even higher quality loans from that loan book. And when I say higher quality, this means that there are no delay or defaults in these loans. There is some seasoning of these loans, which means that for 6 months, 8 months, the loans have been serviced with no delays. And there are some other parameters which make this loan book as a high quality loan book. As an SDI investment, retail investors could now invest into these loans and receive demat securities. And that is the innovation, that now you are investing into these high quality loans approved by RBI guidelines, and are holding as one instrument as a demat security. These loans would provide monthly principal and interest payouts. So this instrument would be a monthly amortizing instrument. So principal and interest both come back every month. On top of this, what we also do is provide a credit enhancement by providing a security cover from the NBFC. And that's why it makes for an attractive risk reward instrument. Just if the audience, like understands corporate bonds, when you invest in a corporate bond of an NBFC, what you are basically doing is the underlying asset would be the overall loan book. So essentially, when you are investing into an SDI, your underlying asset becomes of higher quality. And since it is an innovative instrument, right now there's an arbitrage in the market, and thus providing better interest rates over a normal corporate bond. So that is the idea of an SDI. The pool is very granular. The diversified exposure is very, very low to an individual borrower. The fixed monthly payout makes for a good fixed income instrument, and two, minimizes risk as the tenure passes on. Generally, the deal tenure is around 12 to 18 months, and the minimum investment is 1 lakh.
Great, Vaibhav. So this is clear. So what Vaibhav just mentioned is a method for NBFCs to offload a certain amount of loans from their books, which are assets, right? So let's say NBFC decides to basically let go of certain amount of high quality loans from their books for whatever reasons that they could be having. Uh, for doing that, we as investors tend to partake and become, I would say, part owners of those loans directly by securitizing those loans into a trust. So all of these, the entire mechanism is highly regulated. It is a framework that has been designed by SEBI. Each of these securitized transactions are individually assigned a credit rating. So it is not that the credit rating of an NBFC is automatically passed on to the credit rating of the instrument being created, because the underlying loans are typically tend to be of a higher quality. These tend to again get separately credit rated from what the NBFC is being rated at. Again, these are currently today shorter tenure deals of 12 to 18 months. So you're again not taking on a huge amount of interest rate risk, or whatever risk that could occur if you're investing in, let's say, a 5 year or a 10-year bond. And the biggest advantage is that you receive fixed, periodic, and stable monthly payouts straight into your bank account.
Yeah. And here is where it gets really interesting. Okay. And we had that picture of a David versus Goliath. SDI as a concept is not a new product. It's in the last year, financial year itself, 1.8 lakh crore of such loans were securitized under a similar framework of SDI. Where it gets interesting is that the only participation that SDIs attracted were from institutional investors. And you can see some of the names on the right side of the screen. All relatable names, right? And HDFC and Axis, Citibank, Kotak, so on and so forth. A very large industry only being participated by institutional investors. And that's where what we are trying to do is how to bring these to individual investors. The SDIs that we create, the previous tranches, are also in some way have been participated by institutional investors. So that gives an extra layer of validation to what we are investing in. Yeah.
Right.
And further, just if we look at the returns, again, wrapping this up, a bank FD would give a 6.5% return. An A-rated NBFC would go to 7.2%. A-rated corporate bond would give 10.9%, but an A-rated SDI by GRIP is anywhere between 13 to 13.5%. And that's the alpha that we have created. And again, since the rating is similar across the spectrum, except for the bank FD, you can say that broadly the risk is the same.
Right. So, quick question, Weber, over here for our audience. Why do you think the arbitrage exists today? If one wants to, let's say, invest in an A-rated NCD, which is giving 11% from an NBFC, but that same, let's say, an SDI of that say of a different book, but from the same NBFC is giving you 13%, right? Obviously, there is a certain amount of risk, but why do you think the arbitrage today exists in the market?
Yeah, good question. So if you just one one reason is of course lack of access. So whenever there is a mismatch in supply and demand, the arbitrage gets created. But the second, even more interesting point is if you look at this, if an NBFC is rated, say, triple B, when you are investing in the corporate bond of that NBFC, the bond would also be rated as triple B. However, the SDI of the same NBFC would be rated higher because of the higher quality loan as an underlying asset. So now you've gotten a better rated product while the cost of capital for NBFC pretty much largely remains the same. And that's where a better rating is now providing you the same kind of returns which a lower rating would provide. And that's where the arbitrage gets created. So now
Okay.
you are getting returns of a triple B rated bond in an A rated SDI. And that's why there's a difference in the returns of the similar rated bonds.
Got it. Understood.
Yeah. And the industry is not new. Now, GRIP is also not new. We have a track record of facilitating 800 crores through retail investments. 95% of our AUM is retail and granular. So again, staying true to the mission, we are not building it for large family offices and so on and so forth. It is the retail investments that have gone into these numbers. We're fully regulated. We're a SEBI stockbroker, SEBI OBPP license, fully regulated platform and fully regulated products.
Vaibhav, do you just want to give a sense of the default uh, uh, up until now, the default rate?
Yeah, so we have taken up almost 12 SDI issuances now, and I'm glad to say that there has been zero default up till now, and the
Okay.
performance has been really good. Yeah, just last thing, Varun, we were discussing, right, how we have created this product, it makes sense financially, it makes for a good risk return objective, but how do we offer it to retail investors? And that's where also we provide a completely online investment experience. It's akin to buying a share on Zerodha. I would not go into the details, but all your investments at GRIP are executed through the National Stock Exchange. And that has been the real game changer that GRIP has brought to the market, not just as a financial innovation on SDIs, but also the tech innovation that we have done to provide this experience to the investors.
Right. So let's say just in terms of the settlement of securities, right? So I think retail investors today are very, very familiar that when they are purchasing units of mutual funds or investing in stocks, the counterparty over there is the Indian Clearing Corporation, right? So they exactly know who the money is going to, and they know the securities are going to get settled in a similar manner. So in a fixed income product also today, all the investments are being done with NSE being the counterparty. So it is not that you are transferring money in the books of GRIP or some other broker dealer. All the money is going to the clearing corporation. The buyers and the sellers transact through NSE's request for quote platform. So your money is safe and secured at all points in time, and there is no single day of your money getting locked up with a broker or anything else.
That's exactly right. Yeah. There are no escrow accounts in the middle. These are not GRIPS accounts or even the counterparties accounts. The fund flow and the securities flow are directly happening through the NSE.
Great, obviously. So I think we are running short of time a bit. So we'll quickly see now why we have discussed as to, where today most of the investors are invested today, why there is a real lack of participation in the debt capital markets, what is the alternative, and more importantly, when we're talking about fixed income, why today, as we speak, is an opportunity time to actually increase your exposure to fixed income and lock in the yields, right? So the first reason today is interest rates, or the returns that you are able to generate from fixed income products typically tend to move in line with the repo rate in the economy. And repo rate is simply the rate at which the Reserve Bank of India, the central bank of our country, is lending money to financial institutions like banks, right? So as you could see from the chart in the screen, the repo rates and the yields, which is the 10-year government of India yield, typically tend to move in lockstep, right? So once the interest rates start to go down, the repo rates start to go down, there is also a subsequent reduction in the yields, or the return that you are able to generate from investing in, let's say, a 10-year GSEC bond. Once that starts to increase, you are able to see a similar effect, right? So obviously, intuitively, it makes sense to be investing at the peak of the interest rate cycle. Now, obviously, this is something that the central bank of our country will not come and tell you categorically that today we are at the peak of the interest rate cycle. This obviously requires a certain amount of, I would say, knowledge to be able to parse through how macroeconomic conditions are in the economy and what is typically the range and parameters within which the central bank actually tends to move the interest rates. But in all probability, today we are at the peak of the interest rate cycle. So today it is the best time to be investing in fixed income because you get to benefit in a couple of manners. Number one, you get to actually lock in the yields, right? Because today now, let's say the interest rates start to decline in the next 6 to 12 months, the interest rates will start to fall off. So today you get to invest at the top of the cycle and lock in the yields for whatever investment horizon is. The second biggest advantage of doing and investing at the peak of the cycle is that you also get a chance to position your portfolio to earn some capital gains. And let me just quickly explain that to you. Similar to how investors actually buy and sell stocks, right? They also buy and sell bonds. So typically, when interest rates start to go down, now the bonds which have been issued at a higher interest rate cycles, the value of those bonds start to increase. No, common knowledge, because that is more valuable, that is giving you a higher coupon rate over there. So obviously you also tend to gain some capital gain. So this is the biggest advantage by investing in fixed income instruments at the peak of the interest rate cycles actually help you magnify your returns. So that's number one. Number two,
Yeah.
if we look, yeah, Web, do you have anything to add over there?
Yeah, and like you rightly said, it is not just the best time to invest in fixed income securities, but also if you think about a smart investment would be a longer duration fixed income investment right now. And you explained the market logic and how prices and yields move. So, for example, right now a 24-month SDI is more attractive than a 12-month SDI because you are locking higher yields you are not just locking higher yields, but you're also locking higher yields for a longer duration. Yeah.
Right.
Um, yeah, the second reason of why fixed income investing is right, but also it is right for retail investors because regulatory bodies and agencies they're just a string of concerted efforts for making direct investing also attractive. So not just fixed income, but direct investing. Um, the first one was the reduction in face value of private listed bonds. So up till December of 2022, the privately listed bonds had a face value of 10 lakh rupees, which meant a retail investor had to shell out 10 lakh to buy into one bond. Post December 2022, SEBI reduced the face value to 1 lakh, which is phenomenal, a 90% reduction, and recently also came with a consultation paper of reducing it further to 10,000. It's a very clear signal on how even the regulators are thinking of deepening the bond market into for retail investors. The second is the indexation benefit. um, indexation benefit is now removed for debt mutual funds, which makes it a level playing field for other instruments like a securitized debt instrument in terms of taxation. So now all interest income is taxed at your marginal tax slab. And the third really interesting development is this advent of digital platforms like Crypt and also the regulations around it. So earlier even if there were platforms, there were no regulations, and that was risky for retail investors to dive into unregulated industry. But now fintech platforms have made it easier, and also a new regulation by SEBI called OBPP regulation, which is online bond platform providers, has just made it homogeneous and fully regulated the industry. So yeah, it's best time for fixed income, best time for fintechs into fixed income, and best time for retail investors to make use of it.
Right.
Though I would throw a word of caution here. I think Varun, you touched upon it earlier on how you should not chase just the high returns without understanding the risk. So there are unregulated platforms offering unregulated fixed income products, could be offering a risk-free 18, 20, or assuring a risk-free 18, 20, 22% returns. But I would just say that the audience should be cautious while going into that unregulated territory.
Yeah, if it's too good to be true, it's probably not true. I think that is something that, as a maxim, that you have always heard ever since you have been investing. But again, I think bull markets are such that people tend to obviously get swiped away from that, right? So obviously, I think we have seen a couple of instances just very recently where the regulator has had to come down on all of these unregulated platforms, giving investors access to so-called risk-free, assured, mid to high teens returns. And today, if the government is borrowing from you at about 7%, right, which is the true risk-free rate in the economy, I don't think so. Giving you 10 percentage points of extra returns without any risk is a very good idea, right? So again, I think people need to also have understanding, keep your return expectations very well in control, and obviously apply your own level of knowledge before taking any further investment decision. So obviously we have touched upon two reasons why fixed income is ripe right now, and obviously the last one is equity markets. Though we have been talking about it over the last 6 months, why mid cap and small cap is overdue for a correction. Every time we talk about it, they show new all-time highs, right? So we never really know when the party is going to stop. All we can just tell is that obviously, if we go by past, if we look at the charts being displayed in front of us, compared to, let's say, an historical average, it is way beyond where it should be at this point in time. No one really knows for a fact when that's going to mean revert, but I think purely from an valuation point of view, purely from, let's say, the run up some of the companies have had in the mid cap and the small cap space over the last 12 to 18 months, in excess of 100% to 200%, I think that definitely requires some sort of cautiousness that investors need to display in these market conditions. And that could be a very, very good sign actually to, book some profits, not investment advice, but obviously book some profits, take some money off the table and invest into more secure products to keep your capital protected, and then earn something over and above that. So these are primarily what we think are the three key reasons why fixed income today, as we speak, is ripe for investing. This is an environment which may not persist over the next, let's say, 12 months, but always what we would recommend is take investment decisions keeping in mind your overall risk appetite, what your financial goals are, and more importantly, whether you truly understand that product. Uh, Returns do come secondary. That's completely okay, but make sure you understand what you are getting into before taking any final decision. Vaibhav, any final thoughts for our audience today? I think this was a fantastic webinar that we have hosted just in time. Why we think this is a good time, but any final parting thoughts?
Yeah, thanks, Varun, for having me. It was an insightful and a fun conversation. Um, just echoing your thoughts on asset allocation, I think it is more important to do the asset allocation right than, how much, where, and just trying to time the market. Um, Yes, and I would just encourage people to look at fixed income more closely. I think the advent is on. Most of the banks are now coming out with reports on how Indian bond market is grow at a crazy growth rate. So yeah, keep your ears and eyes open.
Great, awesome. Thank you so much, Vaibhav, for doing this with us today. We hope our viewers and listeners really enjoyed what we talked about and found it really relevant to the investing environment. So please feel free to subscribe to our channel if you would like to have more of such webinars in the near future. And if you have any questions or comments, please feel free to drop us a note in the comment box below. And we'll see you guys in the next one. Thank you.